To talk to Dukas Copy TV about the European Central Bank rate decision ahead of this week's Make or Break EU summit, I'm joined by Geoffrey Yu, a London-based Senior FX Strategist at UBS. Geoffrey, at the beginning of the week, the credit rating agency Standard & Poor's put 15 euro nations on credit watch and have threatened of a mass downgrade should the EU leaders fail to deliver. Now, do you think this is fully justified or to some extent the headline effect and to apply even more pressure on EU political leaders? Because it's intensified market volatility at a time when investors are desperate to find safety.
I think they are justified in the sense that they're stating the obvious. The market reaction, which wasn't that much in the grand scheme of things, suggests that it's not new information being reflected. So by acknowledging that the eurozone nations themselves face current stresses, they mentioned systemic risk, for example, is just a sign of the urgency of the matters at hand, and the fact that the French and German governments have acknowledged the decision, and many eurozone leaders have said it gives them further impetus to achieve a more comprehensive solution at Thursday and Friday summit. So I wouldn't really characterize it in bad terms. Timing, yes, could have been better, but apparently the French presidency said they already served notice of a downgrade a week ago, and maybe that played a role in the sudden speeding up of discussions in the run-up to this week's summit. So who knows, maybe we can look back and said they did us a public service. We all know that Belgium's government was suddenly spurred into action after they suffered a ratings downgrade. After 500 days without a government, suddenly they had one within 48 hours of the downgrade. So it can be a good thing in the end.
Ahead of the EU summit, market expectations are for at least a 25 basis point interest rate cut by the European Central Bank. Is this in line with UBS's forecasts?
Yes, so we have just revised our interest rate forecast overnight for a 25% cut tomorrow, for a 25 basis point cut tomorrow, and we expect another 50 basis point in interest rate reductions next year, bringing the eurozone referee rate to 50 basis points as well. So much more in line with the quote-unquote zero rate situation elsewhere. This should provide a source of stimulus to the eurozone in general, help alleviate credit crunch-like conditions, and also pressure the euro, because a weaker euro at the end of the day is part of the solution for all these economies, especially in southern Europe, who need to regain competitiveness.
Okay, well, let's talk about what seems to be the most obvious question, but it's what everyone wants the answer to. Do you think the EU leaders are going to deliver? What are the most likely outcomes from this week's EU summit? And just as importantly, what's the outlook looking like for the future of the euro?
I think they will deliver the minimum of market expectations, which isn't that much, to be frank. So it wouldn't really take too many meaningful agreements to prevent the market from selling off sharply, barring a total collapse in talks and no agreements to treaty changes. We think that they will move towards treaty change, closer fiscal integration, something along the lines of a monetary Schengen agreement where a small group of core eurozone countries move forward with integration. If we can get the establishment of some sort of a redemption fund or a redemption pact, which is in line with the fiscal compact that many leaders have been talking about, it would be an added bonus. But I think a lot of people will be focusing on what the ECB has to say rather than the summit itself. If the ECB, through any of its hints, will be willing to come in and purchase government bonds in greater size or just deploy the necessary resources when necessary, then markets would cheer. Now, what that means for the euro, as I said earlier, I think the lower euro is part of the solution. So even if good news provides short-term respite for the euro, longer term, I think that needs to go down as well. We're still quite concerned about Greece. Our fixed income strategists note that next year coercive restructuring of Greek debt needs to take place, and this could bring in a lot of domestic problems. And given that they have a election in the first quarter of next year and are still under IMF and eurozone funding, then everything could come to head in the first few months, and then the judgment's still out there on their overall status. But at this stage, we're not looking into any form of breakup.
You mentioned it briefly just now, so just to clarify, in terms of the best and worst case scenario, what kind of implications will a positive or negative result from Friday's EU summit have on the level of the euro-dollar in the short to mid-term?
If they satisfy minimum expectations, we think eurodollar will continue to trade around 135, so not much will change. If they exceed expectations, which includes, say, the ECB coming out and explicitly saying we're going to widen collateral window, do more unsterilized bond purchases, or rather just outright do unsterilized government bond purchases, then eurodollar will rally, though we would choose to sell into that because it's just a short-term fix. Longer-term imbalance adjustments will take a lower euro. Worst case scenario, if they don't agree to anything, the markets continue to sell off and we get to below 130. But most likely, I think we'll just trade in a 135, 137, 138 range for now.
Thank you very much, Geoffrey. I'm afraid that's all we have time for today. Now, to keep up to date with all the major market news driving market volatility right now, stay tuned on Dukascopy TV. Goodbye for now.